Good day, traders, or hello, want to be traders. This is an elementary presentation on financial instrument chart and how we read the chart. The first time I saw a chart, I was about 25 years old, and I was taking a course in elementary economics, a college course. And they told me about the y-axis and the x-axis. And they said that the chart is made with price down the vertical axis, the right-hand margin, that's price. And across the bottom is time. It may be in days, or it may be in hours, or it could be in minutes, or possibly even seconds, but it's time. So across the bottom, we call that the horizontal, and across up and down, we call that the vertical, and we call the vertical the y-axis, and we call across the bottom the x-axis. So everything in trading relates to a chart along that basic guideline that we get from macro or microeconomics. Now, it was 1967 or 8 when I saw that chart. Now, since then, starting in 1998, I've probably seen 1,000 of them, 10,000 of them of charts, because I look at a different chart every 2 or 3 minutes. I'm looking at a 15-minute chart, or an hour chart, or a 2-hour, 4-hour. Sometimes I skip right over to a weekly, or up to a monthly, or down to a daily. But when I'm trading, I'm looking at a 15-minute chart. The chart you're looking at here with the drawings on it that I'll explain in a moment is a 120-minute chart, 2 hours. And we're looking back to the 15th of February, and today is the 4th of March. You see the 15th of February down here. And up here, we're looking at a price. Now, the price of this instrument happens to be around 1975, rounded, is 1974.9, and that's where the market closed today, Friday, the 4th of March. As you can see right here, that's the last candle right under that little crook of those 2 red lines, and come down here, and we finished up around exactly at 2 o'clock in the afternoon on Friday the 4th. And you can see that we come over here and we stretch it out a little bit more, and you'll see 1400, which is right here. Now if we don't move it now. Okay, so we got 1400. That's when it closed. That was the last candle. Now that's 2 o'clock in the afternoon in the Pacific time zone. And that changes depending on where you are in time. Now, that's enough information to give you a perspective on what we're looking at. Now we're going to change the chart time frame from 2 hours all the way down to 15 minutes. So we're just going to go up here and choose 15 minutes. And that drawing up there is going to get really big. You can still see it. And you can see this is the day break, that vertical dotted line there. And this is the end of the week break. I drew this chart before the market closed. It needs to be adjusted. So I want to make sure that I've got that set on snap, so I can, when I move it, it moves right to the top of the chart. It is. So I'm going to take it See if I can move it up there. Oh, I did. I'm going to move this one up there and stick it right on there. And there's a magnet. And I've got a tool that serves as a magnet. It sticks right to that point. Now, what we're looking at here are Japanese candlesticks. They have a special configuration. They have a body, and that's what's white or black. Then they have wick. Some people refer to the little sticks on top or the bottom as shadows. So since they're candlesticks, we usually call them wicks. And these candlesticks are a magnificent tool to interpret the behavior of the market and to anticipate the next behavior of the market. So we can use these Japanese candlesticks, which have been around for 200 years, but the Western world, Europe and the United States, didn't even learn about them until 1996. It's only 20 years ago. That's just recent. They're much better than what we used to have, which were bar charts. And before bar charts, we had line charts. And they all worked for the time, but these work better. So I use them and I talk about them and I try to explain them. And I can actually read what they say. And I'll show some of that to you over time. But today, this is just an overview. My mission is to show you the 4 parts of a chart. There's 4 panels. Panel 1 is up here. And it is the candlesticks. That's panel 1. Here's panel 2. This here is an analysis of another information source in addition to price, vertical axis, and time, horizontal axis. This is the analysis of the 3rd panel, which is volume. And in this particular chart, as I always do, I want to see discrete volume by the time frame. In other words, when I spread this out, I want to be able to see whether this time frame here, that last 15-minute chart, was dominated by the buyers, we call them bulls, or whether it was dominated by the sellers, the red, which we call bears. And on the bottom, on panel 4, is a completely different and separate indication telling us what the average true range is on a 15-minute chart over the day. We're moving somewhere in the neighborhood of 3.34 points per 15-minute period. That's huge. In other words, we're really moving a lot. And if we went back in time about 3 weeks or a month before the invasion of Ukraine by Russia, this would have been 1.5 or 1.25 or something like that. So if we just went over there, let's see, down to 2, that's back a few days. Let's go on back here. Now it goes up and down. See how it's bouncing around as I move time forward? I've already moved over here to, let's see where I'm at. I'll just hit my middle mouse button and click, and it'll show me, okay, that's the 25th of February. That's when they were just beginning to invade. Now notice this number right here. See, it's over there. It right down there, it's $4. Up here, it was not dollars. It's 6 points up here. It's 4 points there. And then over here, right in there, that's only 3. And if we go back in time, all the way down to 1 and almost 2. So you can, when there's not much strife in the world, gold is a flight to safety instrument. And this is a measure of how much movement we get in price, the average true range. And that's why we use it. So we can tell how many ticks or points. Just think of a point as a full dollar and a tick as the small change. And ticks and dollars are different on every instrument. For example, crude oil sells $1,000 a barrel. The point is 1,000 points. And the ticks are $10. Gold is $100 point, and the ticks are $10. There's only 100 ticks. There's only 10 ticks. In a gold point, there's 1,000 in a crude oil point. Now, if I confused you, just get your hands on a chart and then just ask the internet how to this or how to that or how to understand that. And the internet will provide you some information, and you can get answers to questions that you don't know yet by just querying the internet. It's amazing how much information is on the internet about financial instruments. So I've talked about average true range. Now I'm going to take it off the chart. I'm going to remove it. And I'm going to leave on the two kinds of volume. We've got two kinds of volume. I only mentioned the red and green a while ago. I'm going to tell you about the other one now. Now remember this thing up here. I'm going to hit this F so that the candles come back into view and spread out properly. And now I'm going to look at I'm going to enlarge this middle panel. This is panel number 2, and give you a little bit more explanation about this. But first, I need to inform you what this is down here. Now, remember, I said there's two kinds of volume. There's discrete volume, in other words, the volume by the time frame. This time frame is 15 minutes. And if you look at this little candle right over here, it's hard to see. So I'm going to just point to one of the bigger ones. You can see the green in there. Now that's the amount of move that happened on this candle during the 15-minute period that was in there. So I'm just going to have to hit the escape button so I can now want to look at it. So that tells me that the volume was 3,378 for up volume. And the white up there is the cumulative volume on that big white candle right underneath my hand. See, I moved it. Now you can see the big, tall, white candle. That volume there is 23,835 as it built up from over there where the white candles get bigger and bigger and bigger and bigger and bigger until that candle. So volume accumulated by the buyers from this 15-minute period all the way over to this one. That looks like about 3 hours. Let's count them. 1, 2, 3, 4, 1 hour. 1, 2, 3, 4, 2 hours. And 2 more. It's 2 hours and 30 minutes. During that 2 hours and 30 minutes, the bulls had control of the market, and we accumulated the volume all up to, what did I say the number was? 23,800. Now the cumulative volume was 23,800. Now notice the bull volume itself on that one particular was only $3,280, rounded off, $3,378. All right, so I would say 3,380 because I round, because I can remember 3,380 a lot easier than I can remember 3,378. So I round numbers. This is not accounting. This is trading. I am educated as an accountant, and we have to use numbers a lot more precisely. But as a trader, I just want to kind of know what the inference is. Lots of volume in that candle. Now, what happened here? Well, the next candle was dominated by the sellers. And it did accumulate, but not near as much as the bull volume. So we went down from here, we went down to there. Here, we went up, all the way up, get the arrow here, from this low up to that high. And that took 28,000 contracts to move us up that high. And what do we move from? I'm going to put some horizontal lines in here for you. One right there. I'm going to put another one up here. So we move from, let's just use a round number, 1900, 1895 is real close to 1900, and this line's a little bit higher than that. So let's just say this is 1900, all the way up to 1906, because this was 5 right here. So let's come down like this a little bit, then spread it out. You see, it's a little bit higher than 1906. It's 1907. So the high up there is 1907, and the low down here is 1895. Wow. From 1895 to 1907, that's 1,200. Big move. We had some really, really big moves in gold this past 3 weeks, 2 weeks, since the 25th of February when we started all this. Started all this. What am I talking about? I'm talking about the Ukrainian invasion. So let's get back on track and look at this indicator that I've got here that's wider than even the candlesticks. This is analysis. This is volume analysis. So when price gets way up this high, above 70, and it turns red at 70, notice how 70 is right there, and these red things start at 70, and they go all the way up here to 85. When it gets up there, that is a sell signal. All right, now I'm going to have to turn off that snap function I was using a while ago so I can do something with this little circle. I just want it up here so I can point out that this red thing has a peak on it, just like a mountain peak. And there's another one over here. They call it an ellipse. And I'm going to put another circle over that point. I'm going to try to get it kind of in the center of that point. Now notice how that point points up to that fractal high. They call, think of fractions. This is a fraction. This is a little piece of the whole, a fraction. And this fractal is derived from the word fraction, and it's sticking up there by itself like it's a skyscraper amongst all these little 3 or 4 story buildings. And it looks like the Eiffel Tower. See the little base here, and that's the body. And it just looks like the Eiffel Tower. When you see something like that, you know it's a sell opportunity. And there was a real short-term sell opportunity, about 15 minutes worth. And so after this candle here got done, and we got a new candle here, price went all the way up there. And then it pulled back. Now let's take a look at the amount of movement. So the high was 1908.30 and the low was 1902.70. So about 60 ticks, 6/10 of a full point. And then that would have triggered a sell signal, and it went down a little bit, but only went down for 1 15-minute period. Nobody made any money on that deal. Maybe somebody that got in it right up there at the very high made some money down here if they got out right there or right there. But if they waited for here to get out, they lost half of what they gained. And if they waited here, they lost all of what they gained because it went higher. So this was a sell signal, and people did make some money on the short side, on the sell side. but that it was fleeting. It evaporated before they got a chance to take their gain. Here is another sell signal. This one worked and we got about $1,000 out. I don't know if we got 1,000. Let's see what we got. So right here, the high of that candle there is 1909, and the low of this candle here is 1895. So let's look at it from 5 points and then 9 points, 14 points, irrespective of the ticks. I'm not going to try to do that arithmetic, but 14 points is $1,400 because it's $100 a point in gold. So that if you sold it up here, one contract, and wrote it down all the way down to there, and you wouldn't, you'd have sold it here and got out here. So you probably made $1,200, $1,300 if you got in that area and got down here out in that area. $1,200. And what did it cost you to get that $1,200? Well, you would have invested an intraday trade, and that costs $1,000 in gold, I think. Let me kind of show you how to check that out. So I'm going to go over here, and I'm going to go into that. I'm going to go into our instrument manager, and then we're going to go down here to gold. I'll just hit this thing here and choose futures so I don't have to look the junk. And I'll scroll down to the G's. Here's gold. Come over here. You see it. It says $100 is the point value, and this is the tick size. At 0.1 is $10. You divide 100 by $10, you get 10. So there's 10 ticks to a point. And a point's value is 100. In gold, that's completely different in oil. It's 1,000. But the tick value is the same in gold and oil. Don't get that confused. This is an oscillator. When it's up here, it's telling you that it's over. So this is a rubber band. It is an oscillator, but it's a rubber band, and it stretches from the 50% point up here, and then it retracts, and then it stretches to the 20 point down here. See 20 over there. See 80 here. It goes up. It starts up at 70. You don't sell it. You don't sell it at 70. You wait for it to get over 80 to sell it. The best place to sell it's right there, right up there, right up just below that wick top, about 2 or 3 ticks. Sometimes you don't get it that quick, so you get it at 5 ticks from the top or 7 ticks from the top, and you're looking for the money. Now, I've already told you that there wasn't much money made because these 2 peaks are too close together. Now, I've probably confused you a little bit, so I recommend you watch this video multiple times, spread over 4 or 5 days, every other day for 3 days, every 2 days for 5 days, every week for 3 or 4 weeks, watch it multiple times. And then if you don't understand something I've tried to explain to you, write me an email. I'll explain it. Or go on the internet and ask questions about the different pieces I told you about. Bottom line is, this tool right here is your relative strength index. And when it goes up to above 80, sell whatever instrument it represents. When it goes down below 20, buy that instrument and take a ride. And after you bought it, if it goes down below that peak or below that peak right there, make sure you exit 1 tick below that low. That's your risk. You must have a stop on when you go in case you're wrong, and you're going to be wrong 20, 30% of the time. Hopefully you're wrong 15 to 20% of the time, and you don't lose too much money. But sometimes it's 30% of the time. You want to never trade if it's over 30%. But looking at it, the way we look at it, we got that stop there. So we want to get in right in here, and the cost between that area right there and where your stop is 1 tick below. You see that little space in between there, between the peak and that horizontal line? That's your tick. That's 1 tick right there where my finger is. It's your stop. Your stop's 1 tick below, but it's 7 to 10 ticks below this line here, and that's going to cost you 60 or 70 bucks if you're wrong. But you're gonna make $50 to $200 if you're right. So you risk $70, $80, $90, $100 to collect $200 or $250. Sometimes it goes all the way to $300, but we don't count on that. We count on $150 to $200 gain when we go in, and sometimes we're wrong and we have to take a loss, but we win more than we lose, and our win-loss ratio is well over 75. As you're learning this, we don't recommend that you ever put any money at risk. While you're in the learning stage, you want to use the simulator, because you can do everything you can do on the simulator that you could do with real money, just using simulated information, simulated data. Remember that candlesticks are the name of the game. The oscillator helps you interpret the candlesticks along with reading the candlesticks, which we'll teach you later. And then the volume indicator tells you what's going on with volume, because volume drives momentum and causes movement. If there's not any volume, this will not move up there. If there's not any volume, it won't move down here. It won't move. These candles will not move unless there's volume, unless there's transactions going through. And in the middle of try to trade some of these instruments in the middle of the night. When their main focus around the world in the middle of the night, for people that live in the Pacific time zone anyway, is currencies. Currencies trade at night during the Asian hours. Oil doesn't move at night very much. Some gold moves a little bit. Currencies move. There's 100 different currencies, pairs. We trade currencies in the futures also. Okay, I've given you an overview. I hope this was beneficial to you, and I welcome you to join us live, watch us trade live in Zoom Room Radio every day from 5 to 7 a.m. Pacific, and that would be from 8 to 11 Eastern afternoon in Europe. We hope we have helped you understand a little bit more about the financial markets from observing this presentation. My name is Richard, and you can reach us at Zoom Room Radio on SwissFT.com, and we'll trade right before your eyes every day from 5 to 7 a.m. The best trading is from 5 to 6 a.m., and then we take a short break between 5 minutes to 6 and 5 minutes after 6. Come back and trade for another 30 or 40 minutes, and then we finish. Thank you. Goodbye.